You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right, let's get to it. We've got a lot to talk about. We did one of our most advanced strategies last week. We did a double butterfly, and we are on this would be episode 392, and I don't think that we've ever looked at a double butterfly in the marketplace. And the markets today, we are taping Options Playbook Radio, and it is Wednesday the 8th. The markets are closed, and there is a much different picture on Wednesday the 8th than there was back on Wednesday the 1st. Overall, markets are feeling way more comfortable about things. We saw the VIX last week skyrocket up to around 35%. And now today on the close, we see the VIX at 1990, below that magic 20% level overall. What a change a week makes. The S&P 500 index, which the VIX is based off of, is closed today at 4,701.21, up $14.46. But even though it was only up about 0.33%, we saw the VIX index drop about 10%. So one of the things that was real interesting last week is that we saw a lot of times where the market would actually have a flat to an up day, and the VIX just would not move whatsoever. It was hanging in that 30% range, anywhere between 28 and 35, and it just really wasn't waning. There just seemed to be so much more concern last week about what's going on in the world than this week overall. And it probably had to do with the new Delta variant and what a lot of the pharmaceutical companies have said overall about the ability for the vaccines to actually handle it, and the fact that they just are coming up with new technology every day in and day out to try to combat the virus overall. So I'm assuming that that's a big reason why we've had a couple of solid up days in the market. So with that said, let's get back to the double butterfly. So we looked at the double butterfly. The markets were closed. It was December 1st. We had the S&P 500 index trading at 4,513. And it was down about 53 points on the day. So we did have the VIX up high. And my biggest thing that I talked about on the podcast was that when volatility is high, butterflies are cheap. And that was the whole rationale behind why we would consider a double butterfly in this instance. Some people might want to just trade the VIX index overall, maybe want to get bearish on the VIX. Now that has nipped you before if you've ever traded VIX options, assuming that high implied volatility can't go higher. But one of the things that the S&P 500 index does, if you're trading it and you're looking at a butterfly, who knew where the direction was going to go overall? But you do know that if we do have a high VIX or a high implied volatility in almost anything that you're looking at, the butterflies in that underlying are going to be fairly cheap. And it's all to do with the fact that you're going to be selling 2 option contracts to try to help pay for 2 other option contracts. So when the juice is high in those options, a lot of times it will reduce the overall cost of the butterfly. So we didn't have any regard to direction, which you don't necessarily need that in option trading. So we went a little bit below the market with a put butterfly, and then a little bit more above the market with a call butterfly. So the one thing that we were assuming last week was that the S&P 500 index wasn't going to stay where it was, and that the VIX was high. There's going to be some volatility in the marketplace. Let's do 2 very short-term butterflies and see which one pans out. So the very next day, if you were to execute, and now as always, we talk about Options Playbook Radio, and our strategies are not meant to be recommendations. We're just trying to learn. But if we were to execute on the close that day, when the markets were closed, because we were taping it right around that 4:30 Eastern time mark, we saw that the put butterfly with our center strike at 444. So 4440 is what our short put strike was at. We could get a 20-point wide butterfly done for a net debit of 90 cents. That means you were risking 90 cents for the potential, if you were dead right, extremely accurate on your short strike of your put butterfly, you could make $2,000. So very low risk, fairly high reward. But premiums were high also. So you needed to be within your butterfly strikes closer to the expiration date. So we did the Friday expiration, December 3rd. We only gave 2 full trading days for this to live overall. And we don't pick the day that we don't get to pick the day that we tape Options Playbook Radio. So you might have put it on the close on Thursday overall. That wouldn't be that bad of a strategy, but we did it on Wednesday and it was fine. So what happened in the marketplace? Well, the very next day on the 2nd, we actually had the market take a small downturn overall, but it never got within the range. The low, since we talked about the put side of it, was 44.60. And not bad, but it went there fairly quickly. I don't think I would have traded out of the butterfly at that point in time. It wasn't within our 40-point wide zone that we wanted it to, but it came very close. It got to one of the long strike on the put side. I probably would have just stuck around, just let that ride, because it was day one of 2 full days of trading in the S&P 500 index, which there's a lot of premium in S&P 500 index option contracts. All right. So the market turned, and by Friday on the open, we actually were at our short strike on the call side. Now, we won a little further out of the money on the call side, and I talked a little bit about that because of the way that there is volatility skew. The call butterfly was a little bit more expensive than the put butterfly. So we looked at buying the 45.80. We're going to go 20 points wide again. And we sold the 4,600. That was our middle strike of our butterfly overall, excuse me. And then we bought the 46.20. So we wanted the market to go to 4,600, and lo and behold, it did, but it didn't hang there for very long. It was on the open on Friday. We would rather have it be in that range on the close. But if you're at your short strike on a butterfly with less than 1 day to trade, guess what you do? You trade it. You get out of that position overall. You might have even thought about doing it on Thursday on the close, but I probably would have waited to the open on Friday overall. But you didn't have that much. But if you waited around till about 10 o'clock or so, the market was down, and the market ended up that day at 45.38, which would have been out of the money. So if you wrote it all the way to the close, then you would not have had a profit on the trade overall. But total risk, we paid 90 cents for the put butterfly if we could have filled at the midpoint, and $1.50 for the call butterfly. So we had $2.40 worth of risk. Hopefully we could have got out and maybe doubled our money, 2,000 on the open overall. It has a lot to do with as much implied volatility coming out of that position while we were trading around the 4,600 level. So interesting trade, a lot of fun to watch on a double butterfly. Really need to understand option pricing if you're going to be messing with the S&P 500 index with the VIX trading around 30% implied volatility, because that is, you're trading as much a drop in the VIX on those option contracts as you probably were trading the actual movement of the marketplace. We're just hoping to get lucky with the movement, but we needed time decay and implied volatility to come down. And one of the things that is very true about all options, I don't care what the underlying, when they get to expiration, there is no more time premium in the option contracts. I don't care what you're trading overall. So that fact weighs heavily when you're thinking about trading butterflies. I don't care if it's a double butterfly, modified butterfly, like I like to call them skip strike butterflies. You're always cognizant of when that expiration is, and you're always trying to pick the right expiration when you're doing that trade. Okay, let's change it up. One of the things about that has happened since we talked about the double butterfly is that the VIX is now down below 20. So I wouldn't want to do a rinse and repeat necessarily. I'm not saying that it couldn't pan out, but we went from a VIX at 35 to a VIX all the way down to 20. The butterflies are going to be a much different price, even if we're just going to this Friday expiration. So we're going to go from one of the more advanced strategies, and we're going to do a fear missing out trade. I received information from Options Insider Radio overall that they posted today about the most active option contracts overall. And in that information, it hinted that Apple, after setting a new high a couple of times this week, it was the most actively traded option contract today. And with that said, most of the volume was on the call side. 2.66 million calls traded versus 867,000 puts. So that was a 75% ratio towards the calls over the puts. So fear of missing out. You hit an all-time high. If you've been thinking about buying Apple and you just didn't jump in, what's one way that we could take a position and have still have some good upside in Apple, but have limited and known risk? So, and I like this type of strategy when you're going into the new year, especially in liquid underlying stocks, because you do need liquidity if you're going to be buying option contracts that are going to go out further in time. You want to have decent bid-ask spreads. So our trade this week is going to be buying an in-the-money call option as a substitute for buying the stock outright. So Apple today closed at 175.08. It is up $3.90 on the day. That was about 2.3% overall. And if we're looking at that trade, we're going to go further out in time, because we're literally trying to use options as a substitute for buying 100 shares of stock. If we were to buy 100 shares of stock, we're talking about $17,500 to buy 100 shares. If we're buying an option contract, it's going to be a lot cheaper, but we do want to go in the money because we want this to be a surrogate for owning the stock. So we're going to go out to the July 15th expiration, 219 days away. We're looking for an 80 delta, and guess what? I found one. The 145 strike call is trading with the markets closed at 35.80 by 36.50. Now, that's 70 cents wide. It's a little bit wider bid-ask spread. If the markets were open, I would hope that it would be a little bit tighter than that. But that is the only issue that I really see in buying options, buying call options, deep in the money call options as a substitute for owning the stock, is the stock's a penny wide and the option contracts aren't. But now we're only putting up about 20% of the stock price overall. So I have to deal with the bid-ask spread. I would have to work it a little bit. Apple options are pretty liquid, so I would hope that I could get a little bit better fill than what the ask price is, $36.50. But we'll keep it at $36.50. We'll say that worst case scenario, we paid $3,650 for the right to control 100 shares of Apple and the benefit of being able to buy it at 145 anytime up until that expiration date on July 15th, 219 days away. So if we do this, our total risk is 20%. And you say to yourself, well, 20%, I don't want to lose 20% on the stock. That wouldn't be my goal overall. So you're not necessarily managing your risk. And I would take heed to that, in that if I did put on this trade, one of the huge benefits of being an in-the-money option contract is that if the markets go up in price and you're correct on your forecast, you gain delta. Your delta on your option contract increases. And if you'd like to think of it this way, you kind of pick up shares. If my delta goes from 80 to 90, that means that my option contract is now acting like 90 shares of stock, right? If the stock went up 1 and I had a 90 delta option contract, I would expect to make $90 on my option as far as the price is concerned, or the position if I have one contract overall. So as we go up, we add delta. It acts more and more like the stock. It never goes beyond 1, right? It never gets to the point where it acts more like the stock, because overall an option contract is a derivative. It's derived from the stock price. So you should never have an expectation of making more than the asset that it's derived from. But on the way down, delta goes away. It gets smaller and smaller. So my rule of thumb, if I'm doing this type of trading, you have an expiration date. So it's not like we're buying Apple and planning on holding it for 20 years overall. I always kind of have a hard stop when I'm buying in the money option contracts, and that if the stock were ever to come down to the strike that I'm buying, the 145 strike, so we're at 175 right now. If the stock ever came down to 145, I would have a hard stop there. I would want to get out. And one way to know the approximate loss, if I did that, would be to look at, well, what's the at-the-money option contract trading for right now? The 175 strike. Because if the stock did come down to that level, and it came down fairly soon, right, your 145 would be an at-the-money option. So it's just kind of a quick and dirty way to get a good feel for if it goes against you, what your potential loss would be, because options are definitely priced different than stock. And right now we see the 175 call option on the ask trading at $16.95. Let's call it $17. So if it does come down to that level, you're at $36.50 minus 17. If you could close it at that level, that means that you're pulling back in $19.50 on that trade overall. And that's more realistic of the loss that if I was wrong on my forecast, the fear of missing out trade and the market did come down, that's the type of risk that I would be looking at overall. Now, no guaranteed price. All it is an estimate. And as expiration approaches, as we get closer and closer to that July 15th expiration, well, you would have to do the math again and look at the at-the-money option contract there because you'd have some time decay overall. But with that said, other underlyings that you may have and you wanted to trade and you didn't get in, or you just want to own some of it and it's a fairly expensive stock and you just don't happen to have $17,500 in your account to buy 100 shares of that underlying. This is an interesting way to participate in it. And the trade of the week for Options Playbook Radio is to buy the July 15th, 2022, 145 strike call in Apple with 219 days to expiration. Total risk of the trade, if you filled on the ask price, would be $3,650 overall. And we would hope that it would go out. So you want to target on the upside because it is an option. So you got to set where you would be looking to take a profit on the top side. And in my book, if it gets anywhere close to the 140 strike, I'd be looking to get out of that trade on that position. And we're doing this on a one-to-one basis. If you're thinking about buying 100 shares of stock, you buy one call option. If you want to get a little frisky, maybe you buy two. But that would be the concept on a fear of missing out on a stock that has recently hit a new high and was the most actively traded series of options with 75% of the volume going towards the call side. That's it for Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. If you'd like to learn more about the educational events that I put on week in and week out, please follow me on Twitter. My handle is very simple. It's at my name, at Brian Overby. Thanks for listening, and we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.